In March 2023, the tech and banking world was rocked by the sudden collapse of Silicon Valley Bank, one of the largest banks in Silicon Valley and the 16th largest bank in America. How could such a critical player in the world of tech financing crumble so quickly? Let's break down what happened and why. Silicon Valley Bank, or SVB, was much more than just a bank. It was a pillar of the Silicon Valley tech ecosystem, funding nearly half of US-based venture-backed technology and life sciences companies. Startups relied on it for loans, venture capital funding, and essential banking services. SVB wasn't just a bank. It was one of the lifelines for innovation in Silicon Valley. At its peak, SVB was the 16th largest bank in the United States, holding assets worth over $200 billion, but it all came crashing down in one intense week. To understand what went wrong, we need to go back a few years to when everything looked great for Silicon Valley Bank. Between 2020 and 2022, the COVID-19 pandemic transformed the economy. With interest rates at historic lows, venture capital and tech startups were flush with cash, and much of that cash ended up at deposits at SVB. The Federal Reserve interest rate was near zero, which meant it was incredibly cheap for companies to borrow money. Investors were eager to pour money into tech and innovation, and all this cash was finding its way to banks like SVB. Deposits grew tremendously. By 2022, SVB held around $200 billion in assets, a staggering amount. Before diving deeper, let's briefly explain how the Federal Reserve, the central bank of the US, works with regular banks like SVB. The Federal Reserve sets interest rates and also provides loans to high street banks, giving them liquidity and a financial safety net. Banks can borrow money at the Federal Reserve's set interest rate, and they lend money to customers or invest it in various assets to earn a return. But the Federal Reserve interest rate affects how profitable its lending and investment process can be for banks. When rates are low, it's cheap for banks to borrow and hold deposits. However, when rates start to rise, things can get tricky, especially for banks that have locked money away in long-term investments, as we'll soon see. Now, let's talk about what SVB did with all those deposits. With so much cash flowing in it, SVB needed to make its money work. It couldn't simply keep billions sitting idle. So it deployed a large portion of its funds into investments including US Treasury bonds and mortgage-backed securities. These bonds and securities were considered safe, but they were also long-term investments, meaning SVB wouldn't see the returns immediately. The bank believed that these assets would offer steady returns over time while keeping the money relatively safe. This would have been fine if interest rates had stayed low. In 2022, the Federal Reserve took a drastic turn. To combat inflation, they raised interest rates multiple times. From near zero, rates shot up rapidly over the year, hitting their highest levels since before the Great Recession. These rate hikes created a huge problem for SVB. Suddenly, the bank's low-interest, long-term investments were much less valuable. New bonds issued with higher rates were paying better returns, which meant that SVB's older bonds were effectively losing value. SVB now faced a classic financial squeeze. On one side, they had promised returns to customers with deposits, but on the other, the returns from their own investments were falling short. Selling these low-interest bonds would mean taking a loss. Yet, depositors asking for higher returns and some beginning to withdraw funds, SVB had little choice. As interest rates kept rising, SVB was stuck. It needed liquidity to cover withdrawals, but if it sold its long-term assets, it would be selling at a loss. This gap, the difference between what SVB needed to pay out and what it was actually making, was growing wider every day. To make things worse, the very companies SVB had supported for years, startups and tech firms, were now withdrawing money instead of depositing it. Venture capital funding had slowed, and many tech firms were burning through cash just to survive. As a result, SVB's deposit base was shrinking at a time when it desperately needed stability. This vicious cycle accelerated the crisis. As SVB's deposits decreased, they had even less liquidity to work with. Meanwhile, the tech firms that had once relied on SVB's services were now viewing it as too risky and were looking for other banks for their needs. All it took was a spark, in this case, a warning from SVB that it needed to raise capital to stabilize. News quickly spread, and depositors panicked. A classic bank run began. Fearing for their money, depositors rushed to withdraw their funds, and SVB didn't have enough liquid assets to cover the massive outflows. In just 48 hours, Silicon Valley went from being one of the top 20 banks in the US to shutting its doors. Regulators stepped in, and SVB was placed into receivership. The federal government eventually intervened, ensuring that depositors could access their money, but the damage to SVB was irreversible. The collapse of Silicon Valley Bank sent shockwaves through the financial and tech industries. For startups, it was a grim reminder of the importance of financial diversification. For the banking sector, it exposed the risks of over-reliance on a single industry and on long-term investments during times of economic uncertainty. Many experts say that SVB's collapse could have been prevented with a better balance between short-term and long-term investments. The bank may have been better protected if it adjusted its strategy when interest rates started rising. The fall of Silicon Valley Bank highlights the complexities of modern banking in a rapidly changing economy. Rising interest rates, an over-reliance on long-term assets, and a heavy concentration in one volatile industry were factors that no one could ignore. But ultimately, SVB's collapse was a reminder that even the biggest players can fail when they misjudge risk and market dynamics. Do you think it could have been avoided? And what does it mean for the future of tech finance? Let us know below. Stay tuned for more insights into the ever-evolving world of business and finance.